Hi, everyone. This is Camille Sams, and thank you so much for joining the Zen Lender Mortgage channel. I am launching a series of videos about the loan process, and today I wanted to talk to you about what happens when you first open escrow. So at the beginning, there's a lot of information that is going to get thrown to you. There's so much that happens in the first week of opening escrow. It feels like a whirlwind. You have the escrow company contacting you, you have your agent contacting you and sending you information, as well as the lender who is also emailing you disclosures and requesting information from you. There are fees that you have to pay that come up front, and it can be overwhelming. So I want to take this moment to explain what happens in the first few days, particularly the first week when you first open escrow. So immediately upon opening escrow, typically within the first 3 days, you are going to be required to put in a deposit. Most real estate contracts require 3% initial down payment. It can be different in different areas, but that is the general rule here in Los Angeles region where I practice. So you are going to deposit that initial earnest money deposit, or EMD, and it is, as mentioned, it's expected within the first 3 days of acceptance of the purchase agreement. Be sure to use the same funds from the bank your loan officer has already approved for use. This is very important. Inform your loan officer right away if the funds they pre-approved are no longer available in your account, or if relatives have decided to contribute towards the purchase. Any changes in the funds being used for the purchase of the home could drastically affect your qualifications and final loan approval. So be as transparent as possible before drifting off the original plan. So here's a little side note. A 5-minute conversation with your loan officer about a change in your funds will save a future headache to undo a cash deposit the underwriter won't accept later. So often what we get is one set of bank statements, and then money starts coming into escrow from another bank account. Or as we're beginning to talk throughout the loan process, the buyer mentions that they intend to use a different account, which we haven't seen. And it's so important to understand that the lender really is the money laundering police, as well as they are there to make sure that the interested parties, meaning the lender or the loan officer, the real estate agents, nor the seller, are contributing towards the down payment to purchase the home that should come from the buyer or gift funds or from other sources, other acceptable sources. So make sure that you discuss that with your loan officer. And, bottom line, we don't want any surprises. So everything has to be as transparent as possible so that we know where the funds are coming from. Okay. The next step is you're going to schedule and pay for an inspection. So the cost can range anywhere from $200 to a couple of $1,000s, depending on the type and number of inspections that are conducted. Within the first 2 days of opening escrow, your real estate agent will assist you with ordering an inspection of the property. The inspection report is a direct out-of-pocket cost that is not included in your closing costs. So be prepared that these are additional funds that you are going to be responsible for paying, and that money goes directly to the inspector. So this is where you kick the tires to check the condition of the home. Based on the results of the inspection report, you and your agent will discuss any critical repairs and if you will continue to purchase the property. You also determine which repairs to ask the seller to either fix before the close of escrow or request a credit towards your closing costs so that you can fix the items after you become the new homeowner. So a little caveat there, you may have caught that I said you're going to ask for a credit towards your closing costs as opposed to a credit towards the repairs. Now, here's the fun part. Lenders want to look at property like our children. They are perfect and flawless. We don't want to see that there's any problems or anything that needs to be repaired on the property. So your agent cannot submit a credit for repairs that the lender then sees and applies that towards your loan to help reduce your costs, or understanding that these are repairs that are going to be made to the property. So instead, what we have the agents in escrow do is prepare a credit towards your closing costs. So for instance, let's say the hot water heater or the air conditioner needs to be replaced, and the cost to do so is $5,000. So escrow will create a credit addendum, or a credit towards your closing costs, that everybody signs, the buyer and the seller sign off on this. And that means that as a part of your closing, when you're getting ready to put the rest of your money into escrow, you will not have to put in the $5,000. That becomes a credit, and it is deducted from your closing costs. So then that means that that's $5,000 less out of your own money that you had in your bank account that you were anticipating putting into escrow. That's how that money stays in your pocket. So it becomes an accounting notation, if you will. It's a credit. It's a credit towards your closing costs. And that means that that's less money that you then have to put into escrow. So that's how that credit works. Remember, most properties are sold as is, meaning the seller might not be open to making minor repairs, such as patching small cracks or a major overhaul like replacing old kitchen cabinets. That's a cosmetic repair. That's not a functional or safety issue. Typically, it is going to be safety concerns that get repaired, not because you want a different color tile in the kitchen or the bathroom. Your real estate agent will advise on the best approach. The purchase agreement typically gives you 10 days from the date the fully executed contract was signed to remove the inspection contingency, meaning this is your first deadline to demonstrate to the seller you are committed to proceeding with this purchase. Additional inspections could include sewer, roof, chimney, and septic. Remember, the cost of these repairs or these inspections could save you thousands in future repairs. So imagine if you had a roof inspection done and you found out that the roof was on its last leg and it needed to be replaced, and that was going to be $10,000. Well, if this inspection only cost you $500, then obviously that's going to give you the additional information that you needed to know before you close escrow. Because imagine a year after closing escrow or 6 months after closing escrow, all of a sudden there's rains and you've got a leaky roof. So when the inspection contingency is removed, you are informing the seller that you are not canceling escrow as a result of the condition of the property. Now, something to keep in mind, even on new construction, properties are not perfect. They are flawed, okay? There's wear and tear on them. They're old, or even if they are new, they're not perfect. So keep an open mind when you are looking at a property. The seller is not going to hand over a perfect property. That's going to be up to you to go in and make it your own and fix some things that may need to be updated that are not safety issues. So our next step, and remember, this has all been the first week of opening escrow now. What's going to happen is your lender is going to be requesting updated bank statements and paychecks, because it could have been a couple of months from when you got your pre-approval completed, or it could have been 30 days since your pre-approval was done and you provided your financial documents. Well, these things age. And so your loan officer is going to request updated documents, and then they are also going to be sending you your loan disclosures. So this is the initial package of documents that you receive from the lender. It outlines all of your fees. It outlines the terms of the loan, the amount that you're borrowing. And once you sign those, then we're able to order the appraisal. Okay, so there's always like a rush to get all of this stuff done. The cost of the appraisal is going to range anywhere from $450, depending on your market, up to about $800. And the cost of the appraisal will be determined by the type of loan you have applied for. A conventional loan, regardless of the down payment and property type, single family or condo, for a primary residence will be the least expensive. FHA appraisals tend to cost slightly more, maybe $50 more, not like a huge difference. But it's because there are extra requirements for FHA property approvals, and investment property appraisals are the most expensive. If a rush fee is needed to meet the pressing deadline, then another fee, an additional fee may apply. For us right now, that could be about $100 to $150 for a rush fee. Now, what that means is that typical turn times on an appraisal could be anywhere from 7 to 14 days. But let's say that, due to other negotiations that occurred, you needed to get the appraisal back within 3 to 5 days, or maybe there were some other delays that occurred that prevented that appraisal from being ordered in that first week. So you need to catch up and make up some time. That may be another reason why your lender and your agent advise that a rush appraisal needs to be ordered. The appraisal contingency is usually due between 14 to 17 days of opening escrow and is also an out-of-pocket expense. Now, you will see this fee included in your closing costs only because it is a lender-associated requirement. Once your final loan documents are prepared, it will be updated to indicate you have already paid the invoice. So we're going to acknowledge that you've paid it. We're not asking you to pay it twice. You do see it on your closing statement, but you will typically see in parentheses POC, which means paid outside of closing, meaning it was not paid as a part of the escrow process. You paid that fee separately, and that either went to the lender or it went to an appraisal management company for the fee. The purpose of the appraisal is to determine if the price you have agreed to pay the seller to purchase the home is a reasonable amount compared to similar properties in the neighborhood, aka comparables or comps. So, this is really where the rubber hits the road, where you really want to make sure that you're not overpaying for a property. And there's a whole other section that I'll get into about contingency removals, as well as what happens if that appraisal comes in higher, or what happens if it comes in lower, and what does that mean for you. So lastly, the last thing that you'll need to work on is obtaining a quote for your homeowner's insurance. So it's really good to start shopping for your homeowner's insurance to get the best option to meet your needs. A good place to start is with your auto insurance company to see if you qualify for a multi-policy discount. Your real estate agent and loan officer can help refer insurance options as well, but keep in mind that a lender cannot require, nor an agent for that matter, that you use a particular insurance agent. We can give recommendations, we can give referrals, but we cannot make that a requirement or a term of the loan nor the real estate transaction that you use this particular agent. So if that happens in your situation, you should question why and don't use that person. Use your own, okay? So now we're at the Zen moment where you're gonna breathe, and it's time to hurry up and wait. Because now what you've done is you've provided all of this information for everybody else to do their job. So you've done the inspection, now you're waiting for your inspection reports. You've done the appraisal, now you're waiting for your appraisal report. Your lender has had you sign your disclosures, the loan has been submitted to underwriting, and now you're waiting for your underwriting decision. So I hope that you found this information helpful. Please let me know if you have any questions. I'm always here to help, and definitely tune in to the next segment that goes into what happens if your appraisal comes in higher or lower. Have a good day.